The market looks calm. Stocks are still holding firm. Volatility is not showing panic, and on the surface, investors may think the system is stable. But a calm market does not always mean a healthy market. Sometimes it means liquidity is moving quietly underneath. Money does not always leave the market all at once. Sometimes it rotates from one asset to another. Sometimes it concentrates into a few winners. And sometimes it waits for the next macro signal. That is the important message right now. The question is not only whether markets are up or down. The better question is where capital is hiding, where it is moving, and what that tells us about risk. This is the calm metrics. Today we are looking at the difference between surface calm and hidden liquidity. On the surface, the stock market still looks strong. Major indexes have recently been supported by technology, large cap leadership, and the artificial intelligence infrastructure story. The S&P 500 and Nasdaq have reached record closing highs, helped by strength in technology and semiconductors. But that does not mean every part of the market is healthy. It means leadership may be concentrated. When a market rises because a narrow group of sectors keeps attracting capital, the index can look calm, even while the internal structure becomes more fragile. This is why we should not only look at price. Price tells us what the market is showing. Liquidity tells us what the market is doing underneath. A strong index can hide weak breadth. A quiet volatility reading can hide crowded positioning. And a stable chart can hide capital moving away from riskier or less favored assets. That is the first layer of this market, the calm surface. Now look underneath. Bitcoin and crypto are not showing the same leadership as the strongest parts of the equity market. Recent Bitcoin ETF outflows suggest that institutional liquidity has become more cautious. That does not mean Bitcoin is finished. It means Bitcoin is being tested by bond yields, dollar strength, ETF flows, and changing investor appetite. This is important because if stocks are strong but Bitcoin is weaker, the market is not sending one simple message. It is not saying everything is risk on. It is saying capital is selective. Some money is still willing to chase growth, but not all risk assets are being treated equally. That is capital rotation. Money can move into large cap technology while moving out of crypto exposure. Money can move into defensive assets while the index remains near highs. Money can move into cash, bonds, or the dollar without causing immediate panic. This is why liquidity matters more than headlines. A headline can say the market is calm, but liquidity shows whether that calm is broad, healthy, and durable. Right now, there are 5 liquidity signals worth watching. The first is equity concentration. If most market strength comes from a small number of large companies, the market becomes more dependent on one narrative. Today, that narrative is connected to artificial intelligence infrastructure, chips, data centers, cloud spending, power demand, and software. This can support the market, but it can also create concentration risk. If that narrative weakens, the same concentration that helped the market rise can make the market more vulnerable. The second signal is Bitcoin ETF flow. Bitcoin does not need ETF inflows every day to remain relevant, but ETF flows show institutional appetite. When flows weaken, it suggests investors are not rushing to add exposure. They may be reducing risk, waiting for clearer macro signals, or simply rotating toward assets with stronger short-term momentum. The third signal is the dollar. A strong dollar often tightens global liquidity. It can make financial conditions harder for risk assets, especially assets that depend on easy liquidity and speculative appetite. Bitcoin, commodities, emerging markets, and high-growth assets can all feel that pressure. The fourth signal is Treasury yields. When yields rise, investors can earn more from safer assets. That changes the comparison. Risk assets must offer a stronger reason to attract capital. If yields stay high, liquidity does not disappear. It becomes more selective. It asks a harder question. Why should money take risk here? The fifth signal is gold. Gold can rise when investors want protection, but if gold, Bitcoin, and other alternative assets are not confirming each other, the message becomes more complicated. It may mean investors are not making one simple defensive move. They may be shifting between safety, cash, dollar assets, and selective growth. This is why the current market is more complex than a simple risk-on or risk-off label. It is not pure optimism. It is not pure fear. It is selective liquidity. And selective liquidity can make the market look calmer than it really is. There is another layer here. Financial stability risks often build when markets become too comfortable. Valuations can stretch. Positioning can crowd into a narrow theme. Investors can assume liquidity will always be there. Then one catalyst changes the narrative. A bond yield move, a geopolitical headline, an earnings disappointment, a dollar spike, a weak ETF flow week, or a shift in artificial intelligence expectations. The risk is not that the market must crash tomorrow. That is not the point. The point is that calm markets can become vulnerable when liquidity is narrow, crowded, or dependent on one story. This is why the calm metrics does not chase every headline. We look for structure. We ask whether the move is broad or narrow. We ask whether liquidity is expanding or rotating. We ask whether Bitcoin, stocks, gold, the dollar, and yields are confirming each other or disagreeing. When these signals disagree, the market deserves more caution. Not fear. Caution. Because disagreement between assets often appears before volatility returns. If stocks are calm, but Bitcoin is weak, that is a message. If the dollar is firm, but risk assets keep rising, that is a message. If gold rises while equities rise, that is a message. If yields pressure the market but mega-cap technology keeps holding the index up, that is also a message. The market may still move higher, but the quality of the move matters. A healthy rally usually has broad participation. A fragile rally often depends on a small number of winners. A healthy liquidity environment usually lifts many risk assets together. A selective liquidity environment rewards only the strongest narratives. Right now, the market looks more selective than simple. That is the core takeaway. The market is calm on the surface, but liquidity is moving underneath. For investors and market watchers, the question is not whether every red candle is dangerous. The question is whether liquidity is becoming more concentrated, more cautious, or more fragmented. If liquidity broadens, Bitcoin, small caps, cyclicals, and other risk assets may begin to participate more. If liquidity remains narrow, the index can stay strong while many assets stay weak. And if liquidity reverses sharply, the calm surface can change very quickly. So here is the final framework. Watch the surface, but trust the flows. Price tells us what the market is showing. Liquidity tells us what the market is doing. And when the two disagree, the quiet part of the market may be the most important part. This is not a prediction. It is a risk map. The market looks calm, but liquidity is moving. And that movement may tell us more than the headline index level.